And I promise you, you're going to see changes in your business. I got an exciting announcement here at the end, so stick around. I'm going to turn it over to another certified financial educator, senior marketing director. And right now in our organization, as far as I know, has the most assets under management, and those are his cute little boys, in terms of the Series 65, I believe, is under that license. And then I know as far as the Alpha product, which is one of our product platforms, I know he ranks at the very top of the company in all Transamerica. So we have talked a lot about Alpha, which is an introductory platform to active money management. But tonight we're going to kind of take it up to the next level. And I'm not going to take any more time. Patrick, you ready to go?
Yeah, I'm ready to go. Can you hear me?
All right, man. Go ahead.
Yeah. All right. Hey, thanks. Really hard to follow Shantae. Wow, that was I'm nervous, actually. I hope I can perform as well as what you just did. So nice job, Shantae. I'm not going to take too much time because I want to make sure I give you plenty of time, Angelo. But yeah, I do want to talk a little bit about active money management. I want to talk a little bit about passive money management. But some of you are not 65 yet, and I encourage you to get the license. I mean, you know, I don't want to take all my time talking about that, but I just think that if you're in this business for the long haul, if you're planning on being in the industry, you want to be a professional, you got to take the steps to get the license. It just, you just do. If that's not the role you want to play, then that's fine. But if it's something that you want to be in this business long-term and you want to attract a lot of different clients, you want to do a lot of different things with them, you just have to get the license. It's just, my client experience and my relationships with my clients has dramatically changed. I mean, it is far more deeper than it ever has been by having my 65 license. And I just feel better. I just feel like I'm really providing real value for my clients, and I'm able to really touch everything that they have when it comes to investing, insurance, estate planning, everything. I feel like I have the full package. And so, and that gives me a lot of confidence. And so, when you have a lot of confidence in this business, one, you attract a lot more clients. People just naturally want to come to you for your services. And I see that. I don't really have to go out and market myself because of the value that I bring with my licenses and everything that I have to offer. People naturally want to refer me to other folks. So, but I'll tell you, it's not a short road. I mean, this takes time. It takes a long time, but are you willing to put in the time? Are you willing to go through the grind? And you have to. But I will tell you, it's totally worth it. It's totally worth it. So anyway, I want to get into passive and active, but I also, whenever I hear trainings and everyone always does a fantastic job, but I just know that if I'm on the phone, it's 8:45. Many of you have been up since, 5 a.m. like I have. You're tired and you're like, listen, I need to get something out of this. And I do want to talk about active and passive, but I also want to give you some things that you could do with your business right now, even if you don't have these licenses. So one thing I've been doing a little bit more of, before I go to meet, if I know I got to go see a client, or if I got to go see a referral, or I got to go do a matchup appointment with a teammate, and I know I'm going to see somebody that is kind of in that retirement red zone. Okay. That person is nearing retirement. You're going in for, hey, they have a 401k, they need some help. In the past, I'd always be really nervous about those meetings because I wasn't quite sure what I was going to do. The insurance end, that's a no-brainer. It's easy. You do a dime, you figure out what they have, what they don't have, and you put a plan together, okay? But when it comes to the retirement planning aspect of things, it does get a little bit more challenging, okay? But I think a little practice and everybody would have this down. So I've been doing this I shouldn't say recently, probably in the last year and a half or so, I've been really kind of leveraging this tool right here. And so when I know I'm going to go meet somebody who needs some retirement planning, they're in that retirement red zone, I always like to email them or have the trainee email them this retirement monthly needs. Because what I have found that a lot of people that are nearing retirement probably haven't done a budget in a while. And you know what? They're about to retire, and the consistency of income coming every 2 weeks is going away. And so they need to have a really good handle on what they're going to be spending on a monthly basis. And so, this is an example of a lady I met with over the weekend. She was referred to me by her son, and her name is Margie. And I said, "Hey, listen, Margie, really looking forward to meeting with you, going over some things, but you may or may not, and you may want to write this down because I did this in an email, and it just, you want to be sensitive towards this." So I said, "Listen, Margie, I'm really looking forward to meeting with you on Sunday. Here's a retirement monthly needs worksheet. You may or may not have done this already. If you haven't, this really will help us get a handle on what your expenses are going to be in retirement." And so I sent this to her. And when I met with her on Sunday, this was all filled out like this. Okay. So we found out that her monthly expenses are going to probably be somewhere between $2,000 and $2,500 a month. She lives a very humble lifestyle. She doesn't own a home. She rents. She's not married, has a child, and is not really looking to do much except hang out with her beagles. Okay. And I said, okay, that's fine, but let's get a handle on this. So once I know what my expenses are going to be, or what the client's expenses are going to be, then the next thing I look at is what's going to be coming in automatic, and what are things that are automatic, right? And never have to outlive, or you'll never outlive. It's always going to be there. Well, Social Security. So the first thing you need to look at is say, okay, hey, have your Social Security statement ready, or can you pull out your Social Security statement? So she did. And she didn't know how to read it. She looked at the first page, and it told her what her expected amount is going to be, but that was based on her age right now. And I said, oh, well, let's flip the page. Let's look at what age 70 is, because she's 69 years old. And so it was a difference of $400 a month. So her Social Security is going to be $32.47 a month. And then she's got a pension, okay? She's worked for a pension fund for 30 years. And her pension is going to be $46.46 a month. So you look at her total income on a monthly basis is going to be about $78.93 gross. And we factor after expenses, we have a budget of about $4,000 or $4,500 a month. Now, as you can see here, she's going to be fine. I mean, this is a unique situation. Not most people at this age or at this stage of their life have way more income than what she's making right now. I mean, her household income her income right now is take home is about $4,000 a month. She's going to be making more than that. Now, so I don't have to solve for guaranteed income. Now, if she didn't have that pension and her Social Security was around $2,000 a month, then I would have to look and see what other assets she has to be able to generate additional income, guaranteed income. And that's where an index annuity with an income rider comes in play, or that's where a VA comes in play with an income rider. So I use those tools to beef up the income and give them predictability. In this case, we don't need it. Now, the one thing I'm not showing on this page is that she has a 401k with about $85,000 in it, okay? So I don't need to turn that on into an income stream for her. That's more of a slush fund. She's got one adult child, and that's it. So that may be passed on to him. But she's not interested in any additional insurance, maybe some final expense. So I'll look at that with her, like an Everest plan, but not looking at an annuity. So what are we going to do with this money, right? What are we going to do with this, this $80,000? Someone who is almost 70 years old. What would you do? What would you do? Now, if you got your 65 license, you got a lot of things you could do. If you don't have your 65 license or just have a 6 and 63, you may be limited to a mutual fund, which is fine, but you're going to pay an upfront sales charge on that. But you really don't have an opportunity to help her with anything with that $80,000 unless you have the appropriate licenses. Okay. So where do we go from here? So let's take a look at what active versus passive management is. Okay. Now she's moving from a 401k, which, has mutual funds inside of it, which are can tend to be a little bit more of an active play. But it can also be a little bit passive too. So I broke down a little bit about active versus passive. All right. And I try to keep this as simple as possible for you. And then I want to give you a couple examples, and I'll wrap up here in about maybe 10 minutes or so, 10, 15 minutes. But passive investing, okay, some of the key benefits of passive, well, let's take a step back, okay? You really got to understand, really the difference. So, passive investor, you're somebody who generally is going to invest for the long haul. So if you're in your 20s and 30s, I mean, you got 30, 40 years to go, you're probably more of a passive investor. They limit the amount of buying and selling within their portfolios, okay, which makes this a very cost-effective way to invest. When you're not buying, selling all the time, right, that really can reduce a lot of things, especially taxes. So this strategy requires a buy and hold mentality. That means resisting the temptation to react or anticipate the stock market's every next move, okay? And that's the problem with most folks, is that they don't have the appropriate mentality. I remember when 2000 hit, I would have clients call me that are in their 20s and they say, Pat, we should sell everything and go into cash. I'm like, you're talking about your 401k or an IRA. You don't need to touch that stuff for 40 years. What are you talking about? This is the best time to be putting more money in, okay? But a prime example of like a passive approach is buying an index fund. And where can we buy an index fund? Well, you can buy it through the Trans Alpha platform. Okay. And what those do is they follow like a major index, like the S&P 500. So if you turn on the news tonight or you open up your computer, you go to Yahoo, you're going to see what the S&P 500 did. The S&P 500 is the top 500 companies in the US. Okay. So an index fund that follows the S&P will just buy all the same companies that are in the S&P 500. So if you want an example of that, or say the Dow Jones is another index, these are your top 30 companies, right? You can see them here. And then if you see the S&P, here's your top 500, right? 3M. I was surprised to see, let's see here. Dollar Tree is in here. So you can, next time you go to buy your birthday card, like I do at the Dollar Tree, and you have an S&P 500 index fund, you're helping yourself, okay? But so when these indices kick out a company, like you see here, Allstate, let's say it's not performing well, they'll kick that out. Well, the index fund will kick it out as well, because they're just buying all the same companies that are in that same index, okay? But this is a big deal, especially for companies that become big enough to be included in one of these indices. It pretty much guarantees that the stock will become a core holding for thousands and thousands of funds. Okay. So that's a big deal. Now, if you look at active investing, okay, it takes more of a hands-on approach. I remember I was working at a hedge fund called Citadel downtown back in 1999, and I was working in their HR department. And I remember this gentleman, he was an intern as well. And I remember he having lunch with them, and I'm like, so what are you going to do? And he's like, listen, man, I just bought a brand new computer, and I'm going to day trade at home, and I would hear those conversations like at least once a week, right? Or hear those types of comments. And so what they were trying to do is just going to try to time the market, buy a bunch of stock, et cetera. And so that's kind of like active investing, not taking a buy and hold approach. Okay. But the goal of active money management is generally to beat the stock market's average returns. So they're trying to beat the index, right? If the S&P did 10, they're trying to get north of that, whatever they can. Okay. But when they do this, it takes there's a lot of analysis involved. If you want to get an idea of how this works, tune into the new show called Billions. Okay. Because it talks, the show's about a hedge fund manager, and you'll get an idea of what they're doing there when it comes to active money management. But, like I said, so their goal is to beat, the index And there's usually like a team of people that they're called analysts, and they go out and they'll visit the company and they'll look at their balance sheets and see if they're a good company, et cetera. But, if you're sending analysts out there, there's a lot of oversight that requires a lot of money. And so if it requires a lot of money, how are they going to cover that cost? Well, they got to cover it in fees. Okay. But these people need to know when is the right time to buy and when time is the right time to sell. Okay. But the thing is, nobody has a crystal ball. So let's go back to my little scenario here. If I can find it. Oh, yeah. Okay. All right. So again, some of the key fees: ultra low fees, nobody picking the stock, so oversight is much less expensive. Transparency, it's always clear which assets are in the index fund. And tax efficiency, because they're not actively buying and selling, it's not much of a tax drag on the overall portfolio. Okay. Unlike a mutual fund where that portfolio manager may be buying and selling throughout the year, right? But let's say the overall return of the fund is at a negative. That client may lose money and still pay capital gains tax if it's in a non-retirement type of account, meaning that it's a liquid account. So it doesn't have any tax deferral status or tax-free status. Okay. Now, active money managers, proponents of active money management would say this about passive strategies, that it's too limited. Passive funds are limited to a specific index or predetermined set of investments with little no variance. Okay. And they're locked into those holdings no matter what happens to the market. So market goes down 50, you're going down 50%. Okay. They may say small returns because these are passive funds and they're mirroring the indexes. They very rarely ever beat the market. Okay. But some people don't mind not beating the market. They're not trying to beat the market. If the market did 22% last year or whatever it did, I think somewhere around 20, they're happy with getting 20. Okay. It may beat by a little, but not necessarily. Okay. Active managers, on the other hand, can bring bigger rewards, although these rewards come with a greater risk as well. Okay. So here's the advantages of active investing. Flexibility. Active managers aren't required to follow a specific index. So if they don't feel like, hey, listen, I don't like those companies that are in that index, I don't want anything to do with them. Okay. So they can kind of go where they want to go, and they look for those diamonds in the rough. Okay. And they can also hedge. Active managers can also hedge their bets using various techniques, such as like short losses or put options, okay? Or they can exit specific stocks or sectors when the risk become too big. Versus the passive person who's stuck. Like in 2008 when the market went down and everybody in their 401k went down because they were pretty much stuck. In a mutual fund, they're given a prospectus, which is like the owner's manual, right? And the portfolio manager has to stay in certain sectors in the market, no matter what happens, because in the owner's manual that was given to you, they have to stay that course or else they can go to jail. Unlike active money manager, where they say, you know what, we're out of this deal. We're going to cash. We see a huge storm. And Todd has a great story how he tells about a ship in the harbor. It's perfect. You should sit in his class to learn. I'm not going to tell it right now because I'll just destroy it and not give it its justice. But the thing is that they can get out whenever they want, depending on the fund. And so before you choose your fund, you decide, okay, can this particular active money manager go 100% to cash? Now, here's the downside of possibly going 100% to cash is that when you go to 100% to cash, what happens is the market rallies back up. Well, how do you know they're going to get you out of cash, right? And so that was some of the challenges in 2009. Yeah, 2008, active money managers may have missed a lot of that downside loss, but they also, some of them missed the upside in 2009 too, when the mutual funds that stayed the course did rally back. Tax management, even though the strategy can trigger a capital gains tax, advisors can tailor tax management strategies to individual investors, such as by selling investments that are losing money to offset taxes on the big winners. Okay. Now, here's some of the shortcomings. Can be very expensive. Okay. But you get what you pay for. Active managers are free to buy any investment they think would bring high returns, which is great when analysts are right, but terrible when they are wrong. So, I've done some research on this, and I realized that a lot of planners like ourselves, Some feel passive is 100% the way to go. Some feel active is 100% the way to go. But also a big chunk of them feel that blending the two together can be the way to go. Now, Margie, when the lady who I just showed you her expenses for the month, or what her expenses are going to be, that is someone who I'm going to look at doing a little bit of both. With her 401k, I will look at 100% active management for her because she's 70 years old. But for her money, right, the $4,000 a month she's going to have discretionary, that will probably go to passive investing, like a Betterment account. Okay. And so that she can contribute onto it on a monthly basis. She can build up a nice cash reserve. If she ever needed additional funds for, say, in-home care, and the pension and the Social Security wasn't enough to support it, she would have some cash there. Okay. So let's go on. I'm not going to have time to get into the Betterment site, but I wanted to show you just an example, and this is through Hamlin Management. And you can see here in 2008, and this is an active strategy, and your red is your sell and your green is your buy. And it just gives you an idea when this fund manager decided to sell and buy. As you can see here, look at the big dip. Now, if you were in a buy and hold strategy, you would have dealt with all this going all the way down, right? Unless you called up and put yourself in cash. But how do you know when the market's going to recapture? You don't know. But these people do, all right? Or they have a good handle on it. So I just wanted to show you one example here of buying and selling during different times, okay? Now I'm going to show you another fund here. In this fund right here, before I do this, I would encourage all of you, well, for those that are interested, the fund I'm about to go over is pretty much spelled out on this site. And this is called Story Research, okay? And it's open to everyone. You can just go to their website and to learn about this, okay? But it's low volatility funds. So funds that are, or should I say stocks that are not going to deal with much whiplash if market is going to be going all over the place. And also rising dividends. And what that means is when companies their stock prices aren't very volatile to create capital appreciation. Like Facebook, when it went public, it started at 30 and went to 80. Someone sells that's your capital appreciation. But after Facebook has been around for 30 years, you don't see very much fluctuation in their stock price to create capital appreciation. But they're making money. So the way they pass that on to their investors who hold their stock is through dividends. And so RD stands for rising dividends. So these are undervalued companies, or they're moving their way up and they're starting to spit off a lot more dividends. Okay. So let me go back to my example. So this is through one of our firms on the Trans One platform called the Flexible Plan Investments. Okay. And here's just a little snapshot. So, when I prepare for, a client meeting and I'm like, okay, I got to look at some different funds for them. I usually will print something like this out. Of course, I need to send them my ADV Part 2, which is kind of my resume before I meet with them, because that is required by the industry. But this is a form that I will print out and I will review with them. And this is something I'll probably review with Margie. Okay. And this will be, you can choose a conservative, a balance, or a little bit more of a growth type model. All right. So here's a little snapshot in this, and I'm not going to go through this in detail with you. I am going to go over a quick illustration and then I'll be done. But here on the left-hand side, it talks about their asset classes: short-term treasuries, okay, money markets, which is cash, large cap dividend payers, large cap low volatility, okay, that may be like a 3M, all right, large cap blend, and a little bit of international too, which is important. But here's some of the big things is that the one I want to point out here, because you want to look at active for maybe your more defensive strategies. Okay, so on the bear market side, following the daily individual fund signal, the strategy can move to 75% defensive position during large bear market declines. Now, don't you think some of your clients would want some protection, right? Because we all know if you lose 10, what do you got to do to get back even, you know? And so if we can help mitigate some of that downside risk, that may help them recover a lot faster. Okay. Now on the bull market side, they overweight into top performing rising dividend, low volatility ETFs. So overweight means they just put more percentage of the fund towards, the top performing rather than just staying the course with one company, right? Like an Amazon. Hey, we got 10% allocated to Amazon. We're only going to stay 10%. No, if Amazon's kicking butt, we're going to allocate maybe 20% more to them, right? So on and so forth. So here's some strategy specifics, etc. All right. And here is a quick illustration on it. And sorry, it's kind of choppy here. I had to print it out. I have the client's name on here. Here's something I'm working on for another individual. And so FlexPlan, if you call them and kind of tell them client situation, they will put an illustration together for you. But I kind of wanted to just point out a couple things here of how maybe this fund would have performed versus the S&P 500. So this is from 2007 to 2017. No, I'm sorry, 2018. And here is the return on the S&P, the low volatility fund, the Dow Jones, and the NASDAQ. Okay. And the risk is the standard deviation. Okay. I really don't want to spend too much time on, you'll learn about this in your, when you start taking your, or studying for your Series 65. But the one thing I want to point out here is beta, and alpha. And beta is really what the risk of the fund is to the overall market. And the S&P is always at 1. So how risky is it to the S&P 500? Well, the low volatility fund is only 0.75. It's 0.75%. So it's less risk than the overall market, right? And then if you look at that, and then you look and see, okay, well, how is it performed with less risk? Well, just take a look. Here's what it would have performed, right, since 2007. And this is a $200,000 deposit into the account. So here's your low volatility fund, rising dividend versus the S&P. So obviously the first year, the S&P did a little bit better, right? But the next year, the market went down 37%. This only went down 16, all right? Now it beat out the S&P in 2009, right? So on and so forth. So not too bad over that time frame, 512 versus 472. So again, guys, this is just an example of an active money manager. We have several on the Trans One platform, depending on what the client's objectives are, et cetera. But you know what? There's a place for each one of these, right? Or there's a fit for each one of these types of funds, either on the passive side or the active side for the client. It just really comes down to what the client is looking for and what the time horizon is. The best thing is to meet with an IAR who maybe has some experience and learn about this once you have your licenses. And then there's ongoing training with IARs every month as well. They bring on a different fund manager. We have webinars with them. You can learn about them. But just understand that we have, access to this. So sorry for going a little bit over there, Angelo. I'll let you finish up.